If you want to buy bonds which have built-in inflation protection, you have a couple of choices. Either you buy the individual bonds directly, or you can buy a pool of the bonds wrapped up inside a fund. Each of the two methods has its drawbacks and benefits, so here we look at some of those practicalities in detail. Bear in mind, all of these examples are just illustrative. If you want investment advice, go and see your independent financial advisor. In our inflation video, we looked to see which of the asset classes provide some degree of protection against rising inflation. Bonds don't, because their income is fixed and inflation is the mortal enemy of bonds. Gold was simply not reliable. Its historic returns just aren't linked to inflation. Shares provide a bit of protection, but once inflation reaches about 4%, all of that protection disappears. The only asset class where there's a reliable link between its returns and inflation is inflation-linked bonds. I use an application called ShareScope to look at share prices and bond prices. I've done a simple search for index-linked treasuries. Here's a list of 28 of them. If you want to search for these on your broker's website, you can use these codes on the left. I've highlighted row 14, and the identifier there is TRTQ. The bond was born or issued in 2011, and it dies or matures in 2034, and the price is about £148. So I went to my broker's website, in this case Barclays. I look up TRTQ, and the buy price is £149.24. I click on deal, and oops, I get a message saying this stock cannot be traded online. Please phone us to place an order. So these are the two problems. The trading sizes are big. What if I couldn't afford £150? Share prices tend to be much smaller. The second problem is that for small investors, such as myself, index-linked bonds are harder to trade. They're less liquid than shares. Liquidity, remember, is how quickly you can buy and sell an asset. If I had millions of pounds to invest, inflation-linked bonds would be very liquid, but not for the little guy. This is why we might want to think about an alternative, which is an inflation-linked fund. A fund is just a managed pool of investments. This can be actively managed, where a highly skilled fund manager selects individual assets to buy and sell, but what we consider here are passive funds, which tend to be cheaper. Funds are great because they provide access to a wide range of markets. These can be shares, bonds, commodities, or a whole pool of assets mixed up together, called multi-asset funds. The second benefit, which is very pertinent here, is liquidity. Funds traded quickly, easily, and cheaply. Because we're buying a pool of assets, we get a degree of diversification, but in this case, that's not particularly relevant. Buying a very liquid fund can also reduce costs. We're also buying the expertise of the fund manager. Funds come in many flavors. Here we're going to consider exchange-traded funds. Remember, this is just illustrative and not expressing a preference for one type of fund over another. In the UK, your choices are fairly limited. There are three main inflation-linked exchange-traded funds. They're called exchange-traded because you buy and sell them just like a stock, which means that while markets are open, you just look up the ticker, which I've shown here in red, INXG, GILI, and XGIG, and then you just click on buy or sell, just as if it was a single stock. INXG and GILI are both linked to UK gilts. The third one is a global pool of inflation-linked bonds, not just from the UK, but also from the US and Europe. Whenever you buy a fund, it's always worth looking at the total expense ratio, or TER. If you buy £100 worth of INXG, the expense ratio is 0.25%, which means that you'd pay 25p a year to the fund manager, which is BlackRock. GILI only has an expense ratio of 0.07%, so you'd only pay them 7p a year on your £100 investment. We can look at the fact sheet, again, purely for illustrative purposes. In this case, we'll look at INXG. You can download a description of the fund from the iShares website. For example, we can see that it passively tracks the Bloomberg Barclays UK Government Inflation-Linked Bond Index. Well, that's good because we want to track index-linked bonds. The ongoing expenses are just 0.25% of the capital invested. Income is paid to you 2 times per year, and it's reassuring to see that the size of the fund is considerable. It's almost £1 billion, and of course it's popular for a reason. We can also see the top holdings in the bottom right, in other words the bonds in which that £1 billion is invested. In the bottom left you can see how closely the fund has managed to track its benchmark. Usually it's within 0.1% each year. Ideally we'd want that tracking error to be 0. To show the benefits of inflation protection, we can take two very similar funds. The fund manager is the same, BlackRock. Both are based on UK government bonds, but the one on the left is not linked to inflation. The one on the right, INXG, as we've seen, is linked to inflation. The coloured boxes represent which risks we're taking with each of the two different funds. I've shown 4 of the risks here, and because the contents of the funds are so similar, they share 3 of those risks. But the difference between the two is the inflation risk. Risk and return are related, so very roughly we could say that the only difference between the returns should be compensation for taking UK inflation risk. Let's see how much that pays. This would be the value of £1,000 invested in 2007. The red line is the inflation-linked fund. The blue line is the gilt fund, which is not inflation-linked. In the panel below, I've shown the level of inflation year on year for the UK. Hopefully what you can see is that when inflation is high, such as in 2009, and again around 2012, the red line starts to move up above the blue line, as the inflation protection pushes up the values of those index-linked bonds. Conversely, when inflation is very low, such as in 2015, gilts will outperform. Of course, what's really interesting is that most recently in 2016, we've started to see those inflationary pressures rise again, and as a result, the index-linked fund has outperformed again. It always pays to look at the risks on the fact sheet. A key one here is that if we get deflation, there's no protection of your principal. In other words, if inflation goes into reverse and you get deflation, where the prices of goods and services is falling, then you can make a capital loss on your linkers and on your fund. And also in the small print you can see that the credit rating of the UK may adversely affect the price of the fund. But surely the UK would never get downgraded. Well, actually, yes, it could. This was a story in the FT as recently as January the 18th, talking about the effect of Brexit uncertainty on the credit rating of the UK. And this is seen as a very material risk by many of the rating agencies. So this is something which you should be aware of. And finally, a reiteration of the legal bit. This is not a recommendation. But if you found this interesting, you could seek independent financial advice. And I'm sure your IFA would love to discuss this with you in more detail.